Most people think choosing the best fixed index annuity is about chasing the highest cap rate. That mistake alone has cost retirees hundreds of thousands of dollars. Because here's the truth. The best FIA at age 60 is not the best FIA at age 70. And if you get this wrong, you don't just lose upside, you lose income, you lose flexibility, and you lose peace of mind. Today, I'm going to be breaking down how to choose the right fixed index annuity based on your age, specifically between 60 and 75, and why most advisors oversimplify this decision. Stay with me, because at the end, I'll show you how some retirees are quietly creating a private pension with zero market risk, while others are knowingly locking themselves into the wrong structure for life. A few years ago, a couple came into my office. Both were 66 years old. They already owned an annuity, and their advisor told them it was one of the best on the market. Now, on paper, it looked impressive, but in reality, it had the wrong income timing, the wrong rider design, and the wrong surrender structure. So they really weren't protected, they were just boxed in. And that's when I realized something most people never hear. There is no such thing as the best fixed indexed annuity. There's only the best FIA for your age, your timeline, and your goals. So let me break this down the right way for you. If you're between 60 and 75, your decision should not start with the index, the cap rate, the illustration, or maybe even what your neighbor bought. It should start with one question. When do I want this money to start paying me? Everything else flows from that. Now let's walk through how this changes by age. If you're already in your early 60s, chances are you're still working or you're semi-working, you haven't started your Social Security, and you probably want growth but without market risk. Well, here's the key insight that most people miss. At this age, income riders are often a mistake. Why? Because income riders lock in fees immediately, reducing liquidity and can limit long-term accumulation. At age 60 to 64, the best FIAs typically focus on strong accumulation potential, competitive cap or participation structures, short surrender periods, and preserving flexibility. Think of this stage like charging a battery. If you're over-engineering income too early, you shrink the battery before retirement even starts. So this is really more about positioning, not activating. Between ages 65 and 69, things get a little more strategic. This is when Social Security decisions are happening, market volatility feels more personal, and advisors start pushing income now products. But here's the nuance. The best FIAs in this age range balance accumulation and future income, not one or the other. What you're looking for here is strong income rider roll-up structures, flexible income activation dates, reasonable rider fees, and continued upside participation. You're not turning income on immediately, you're staging it intelligently. This is where the idea of a private pension becomes real. Most people rush into income, but smarter retirees build toward it. The difference? Often tens of thousands per year in lifetime income. In the phase between ages 70 and 75, the focus shifts again and income becomes the priority. At this stage, the best FIA is not the one with the highest growth potential, it's the one that answers one question: how do I make sure I never run out of money? This is where guaranteed lifetime withdrawal benefits, payout factors, survivor benefits, and contract simplicity matter more than cap rates. The best FIAs in this phase focus on maximizing lifetime income, predictable monthly paychecks, stronger carrier stability, and principal protection once income starts. Volatility becomes irrelevant. And that's where FIAs can outperform the 4% rules, CDs, bonds, and buy and hope portfolios, because no market can compete with income you cannot outlive. Now, I want you to save from making the three most common and most expensive mistakes I see all the time. Mistake number one, buying based on a single illustration. Illustrations are hypothetical, but the contracts are legal guarantees. And if you don't understand the difference, you can end up planning your retirement around numbers that were never actually promised. Mistake number two is locking your income in too early. Flexibility first, income second. Once you turn income on or add the wrong rider too soon, you limit growth and options in ways that are very hard to reverse. Mistake number three, believing there's the best annuity. There isn't. There's only the best structure for your stage of life. What works perfectly at age 60 can quietly work against you at age 70 if it wasn't designed around your timing. Here's the framework I use with my clients. When do you want income to start? How much guaranteed income do you actually need? How much liquidity matters to you? How much growth is enough without risk? From there, the best FIA becomes obvious. There's no guesswork, no pressure, and no product pushing. This is what I do every day at Hackenberg Financial Group, comparing top-rated carriers side by side and designed around real retirement timelines. If you're between 60 and 75 and want to make sure you're choosing the right structure for your age, click the link in the description below. You can either watch a short video that walks you through how this strategy works in more detail, or schedule a quick call and we'll map it out together. Again, there's no pressure, it's just clarity. Imagine waking up in retirement knowing your principal is protected, your income is guaranteed, and market crashes don't dictate your lifestyle. That's not luck, that's structure. Thanks for watching, and I'll see you in the next video.